Inflation doesn't feel like a policy. It feels like betrayal. One day your paycheck covers groceries, rent, gas, and maybe a little savings. Then prices jump, and nothing about your life improved. You're working the same hours, for less life. And the strangest part is how quiet it is. No bill arrives in the mail. No politician votes to take more of your money. It just happens. So we tell ourselves inflation is chaos, prices rising for no reason. But here's the uncomfortable truth. Inflation has a pattern. When inflation hits, some people lose purchasing power, and others quietly gain. It's not just economics. It's a transfer machine, moving wealth through society in slow motion, from savers to borrowers, from wages to assets, from people who negotiate once a year to people who can raise prices every week. So the real question isn't, why is inflation happening? It's this: who is inflation paying? This is where money, power, and history collide, and nothing is ever as simple as it looks. To understand inflation, you need one simple model. The economy doesn't have one speed. It has three. Speed 1, wages, slow. Most wages update slowly. You get a raise once a year, if you get one at all. Many workers have little bargaining power, so when prices rise quickly, wages lag. That lag is where the transfer begins. Speed 2, prices, fast. Businesses can change prices instantly, daily, weekly, sometimes hourly online. If you control prices, you can react faster than anyone paid by the hour. Speed 3, assets, fastest. Stocks and real estate can reprice in minutes. Assets respond to expectations, liquidity, and fear. When money loosens, assets often rise first, before wages catch up. So inflation isn't just everything gets more expensive. It's what happens when these three clocks drift apart. Wages crawl, prices sprint, assets teleport, and inflation rewards whoever can outrun it. Here's the historical twist. Modern states didn't discover inflation as a mistake. They discovered it as a tool, not always intentionally, sometimes through crisis. But the lesson stuck. Inflation reduces the real burden of debt without announcing a default. If a government owes $1 trillion, it can pay it back in future dollars that buy less than today's. The number stays the same. The value changes. That's why inflation is often called a hidden tax. It extracts purchasing power quietly, without a vote. This became important after the 20th century's debt explosions, world wars, rebuilding, massive public spending. Governments faced a choice: raise taxes, cut spending, default, or let time and inflation dilute the debt load. Inflation became the option that didn't require a confession. People argue about inflation like it has one cause: money printing, supply chains, corporate greed, energy prices. But inflation is usually a stack of forces that hit together. 1. Monetary expansion. When money and credit grow faster than production, prices rise, especially in assets first. Cheap money often appears first as rising home prices, booming stocks, speculation, cheap borrowing. Then it spreads outward into everyday life. 2. Supply shocks. When energy spikes, shipping breaks, or labor shortages hit, supply shrinks. Prices rise because the economy can't deliver enough goods at the old cost. 3. Pricing power. Who can pass costs forward? This is where inflation becomes about power. Some face fierce competition. Others operate in concentrated markets. Inflation becomes a sorting mechanism. Pricing power protects margins. Others absorb losses. Workers get squeezed in between. Inflation isn't just a number. It's a conflict over who eats the cost. Case 1, 1970s America. A collision. Oil shocks, policy mistakes, wage pressures, geopolitics, expectations. Inflation became cultural. People stopped trusting prices, demanded wages. Businesses raised prices. Investors fled cash for hard assets. The cure was brutal. Policymakers raised rates hard enough to break demand at the cost of unemployment. That is another transfer, from workers to price stability. Case 2. Post-war debt dilution. Debt to GDP enormous, reduced through growth, low interest rates, and inflation eroding the real value over time. Debt didn't disappear. It was diluted. Case 3. The recent inflation wave, pandemic disruptions, supply constraints, energy shocks, stimulus, long low-rate era. The pattern repeated, prices moved quickly, wages lagged, essentials surged first, food, fuel, rent. Inflation isn't good or bad in the abstract, it's a redistribution process. Winners, borrowers with fixed-rate debt. Inflation can make that debt easier in real terms. Winners, asset owners. Stocks, real estate, businesses reprice faster than wages. Winners, firms with pricing power, protection, and sometimes profit. Losers, cash savers. Cash is the cleanest victim. Inflation is a silent haircut. Losers, workers with weak bargaining power. Real income falls even if nominal pay stays the same. Losers, renters. Rent resets. Wages usually don't reset fast enough. Inflation rewards whoever can reprice first. It punishes whoever is stuck. Why does inflation so often correlate with inequality? Wealthy households hold what inflation protects: assets, businesses, real estate, portfolios that adjust. Working and middle-class households rely on what inflation erodes: wages, cash buffers, fixed incomes, high exposure to essentials. So the transfer machine tends to run uphill, from wage dependence to asset ownership, from labor to capital. That doesn't mean inflation is a plot. It means structure decides who can defend themselves. Inflation is not equal opportunity pain. It is targeted by position. Inflation isn't just prices rising. It's a transfer system. Who owns assets? Who holds debt? Who can raise prices? Who negotiates slowly? Who lives paycheck to paycheck? Inflation feels like chaos because the transfer is quiet. But the pattern is there. Once you see it, you stop asking, why is inflation happening? You start asking, who is inflation paying? If this gave you a new perspective, subscribe. History has the answers. I'll show you where to look.